We already have that number. Costs new where are you times 15 plus I have the annual fixed cost times 6. Gross profit uh, sales of new plus sales of old minus costs of new uh, minus costs of old. How is that possible? That number is incorrect. Let's do that again. Okay, I must have hit the wrong thing. That's the gross profit, all right? I also need the depreciation. Thankfully, when we were doing the equipment for each of those years, we also calculated the depreciation. So depreciation of the equipment plus depreciation of the building. All right? That's why I wanted to do them in pieces. Well, net income is easy. Take the gross profit minus depreciation, multiply it with 1 minus the tax rate. And OCF is also easy. Take the net income, add the depreciation back. And let me move this to the end. Cash flow. We calculated OCF here. Net capital spending here. Change in net working capital here. And cash flow from assets is simple. OCF minus I think I made a mistake over there. OCF in year 0 is going to be 0. Yeah. So these are basically cash flows of the project. All right. And if you wanted to calculate NPV, you could use the template, but it's a lot easier. Did we say cost of capital in the parameters? Let's say that's 15%. Let's make the tax rate 22. I meant to type 22. The Excel function NPV with the rate that's basically the future cash flows. That's the present value of future cash flows. Obviously, to that, you need to add that one. It has negative NPV, hence we would not accept the project. Or the IRR. It's not too bad either. If the cost of capital was 12%, we would have accepted the project. I made this on purpose a rather complicated project because it has all the bells and whistles we want. We can make decisions on what to include, what not to include. Let me save this as a different name. Just a second. Because I am at an age when I don't do something when it needs to be done, it doesn't get done. Yes. If she can be a little bit louder. Exactly. Exactly. That's why we spend a lot of time, even in basic finance, on things like these. If you don't consider, for example, side effects, let's, since this is parametric, all I have to do is, where is that? Make that 0. That would be ignoring the parametric. Well, IRR goes to 14.20, okay? Well, it's an increase. And you would easily make the wrong decision, depending upon the, let's see. Suppose it doesn't require that much net working capital. It looks like 15% almost IRR, and at 14% cost of capital, $1.6 million in what you want to call net present value. Why? Because I ignored the side effects. Even here, it looks like I'm making some money because of the increase in the value of the project. To be conservative, you should make that same. In that case, it's negative. Okay. Technically speaking, you're making money, $5 million from the land. There's kind of two schools of thought over there. The reason we're not selling the land for 5 years because we're using it for the project. Hence, we're entitled to that $5 million increase. Another one is maybe the firm would have held it to begin with. As a manager, my approach would be show me that this project is valuable without that additional 5 million. If it is, then I got no problem. But if I put the side effects back in, I'm losing money. So it does make a difference. Anytime you launch a new product, unless it's kind of a brand new product, there's going to be side effects. This is not limited to Gillette. We added our accounting program. We took our accounting program fully online on eCampus. We had a lot of students on eCampus. eCampus looks at it, they say, we're printing goddamn money. All right? Jesus already died yesterday, so I can sin. I'm agnostic. Don't worry about it. The trouble is, yes, you had a lot of students on the eCampus program. What happened to the program that you already had? It's not like we started from being a business school with no accounting program. Turns out, total additional number of majors, because we added an online accounting program, is 10 to 15. Normally, we would go for that. But the trouble is now we have two programs that are delivered separately. So cost of delivering that close to doubled. If you actually make that analysis, and at the time I told them this would be the case. Of course, my nickname is Cassandra. Just look it up from the old Greek mythology, the Cassandra effect. They didn't listen, and now say, "Oh, you were right." Well, you lost a lot of money in the meantime. But cannibalism is always important. Anybody that comes to you with a project that doesn't have any side effects, you should question their sanity or integrity, or both. I don't know. A lot of times, these guys who come up with new projects, they fall in love with it. They don't necessarily see the negative effects. You got to always look at with a critical eye. So project evaluation is not simply say, "Oh, here's a new product. We're going to sell 1 billion." Maybe, but what's going to happen to your existing business? It's what happens to the firm overall that matters. Let's pause here. Let's get back here at 7:20. Then we'll do a number of problems from chapter 9. All right, let's continue. There are a few things that we didn't directly talk about that you should have read in the book, but as they come, I will talk about them. Two. All right, we didn't talk about this. Let me copy this. It's called